All right, my friends, I've had a lot of people email me about this video from a Real Vision, the coming retirement crisis. And I've listened to it a couple times, and I want to give my take on it because it's a pretty popular video. Let's take a look. We got, I'm not familiar with Real Vision other than this video, but he's got almost 1 million views. He just published it on October 2018, excuse me. He's got 8,600 thumbs up and less than 1,000 thumbs down, and just a ton of comments on here too. 3,500 comments. And the interesting thing is, if you go to Real Vision, let me get that thing out of the way. If you go to Real Vision, the rest of their videos, they don't have that many. This video right here is the dominant video on their entire YouTube channel. Man, I got no problem with this guy's thesis at all. None. There's a couple of things I somewhat take issue with, but I mean, in terms of, I don't have any qualm with it. I think you should listen to it. And let me give an example. But I think it's optimistic. Again, they call it the coming retirement crisis, and you have all these scare piano playing and whatnot. I don't know why we have to do that. If we want to make a point and we want to scare people, the piano's just, it seems to me, why do you have to do that? That doesn't make sense. But whatever. I mean, people got to do what they got to do, and apparently it's effective. He's got almost 1 million views in less than 6 months' time. But so I'll go into my thoughts on this. A couple, and I'll put a link in the show notes. His whole idea is that everyone is aging rapidly, and there's not enough young people coming in behind us. And what's going to happen is this right here. So listen, and I find this absolutely fascinating, and I completely agree. So listen.
Way. That's not to say all generations and all age groups act the same. But overall, a retiree will spend a lot less than somebody who is in the peak of their earning career. I always use the example of my father.
Exactly.
When my father retired at 60 years old, he was the kind of guy, we were lucky enough to buy a new car every 3 years. It was a fancy German car, and he'd have nice wine in the house and go out for dinners all the time. Cut forward to retirement, suddenly he had his fixed investment pool. That's what he had to live off. He didn't know how long he was going to live for, and he didn't know what the cost of living was going to be.
Yep.
So what does he do? Pull on the handbrake on his spending. Cut forward 5-6 years, suddenly I would say he's spending 60% less than he used to spend in a year. Now, when you multiply that out across the entire baby boom population, you've got a dramatic economic event. And there's no getting around that. This is kind of baked in a cake.
See, I 100% agree with that. I mean, and this is what drives me insane about the whole idea that you're going to spend more in retirement, more and more relative to what you spent while you're working. I mean, it's when you think about it, it's just silly on its face. I mean, it just really is. And on top of that, you need a certain percentage of replacement income when you're in working time, when you have this money coming in, as I told you, when you have this common asset coming in called cash from your labor, and then that stops. Now all of a sudden you have this fixed asset called your investments, however they're positioned. You're going to be a whole lot more diligent on how you spend. And I completely agree with that scenario. Now, this guy says, look, if his dad is spending 60% less, then he put that on to whatever, the 60 million baby boomers, whatever it is, I don't know. What is that going to do to the economy? Will it be a consumption-driven economy? And the answer is probably not. I agree with that 100%. But that's good. That's good. And so his premises and this is where I somewhat take issue with it, is that stocks will inherently go down because they're too highly valued now. In U.S., we have about 70% stock to bond. In the U.K., or not U.K., EU is about 30% stock to bond. And he's looking at as he didn't say explicitly, but we are taking risk that could really be problematic for us if the market corrects or has a recession or has he didn't say depression, but decline of some significant proportion. All of that I agree with. I mean, my goodness, I completely agree with all that. But I don't agree with the idea that we should follow the model of the EU with their negative interest rate policy, NERP. This is the issue that we have to contend with here. And this is what I think. And this guy actually, I thought he made actually, I like this video. I'm not going to lie. I liked it. I don't like the negative, the piano playing and, the risks and all this. But I thought it was actually pretty informative. And he makes a point about having trailers, owning trailer parks and things like that. I thought that was actually pretty insightful. That was a good move on his part to talk about that. He talks about crypto and Bitcoin and all, just whatever. I don't know that much about it. I follow people who do, and I'm not convinced, but whatever. But he did talk about real world scenarios of cash when you have a deflation or a depression. Cash is a wonderful asset to hold. I completely agree with that, 100%. When you have a deflation or a depression, stocks not so much. And I completely agree with that too, without question. But his thought process in the next couple of years will have a recession, and as if that's a big. We have recessions all the time. It's just not a big deal, and this is where the coming retirement crisis, i.e., a recession, is going to come in the next 3 or 4 years. I hate to say it, but what they do? I mean, my goodness, George Bush. What caused George Bush to lose office was in 1990 to 91. There was a slight recession. He raised taxes in that recession, but then in 92, the economy was right back. I mean, it was. And Clinton, because the media was at a tailwind for him, was able to exploit this recession crisis like crazy. And but it wasn't that. It was Perot coming in. Recessions happen all the time. This is in October 2018. The market was in the midst of a bear market crash, essentially, and it already went down 25% from basically August 2018 to December 15th or so 2018. So we've already had a bear market, not significant proportions, but a bear market nonetheless. The first bear market we've had since March 9th of 2009, which is much needed. Now he uses a price to revenue to say how stocks are highly valued. I don't like price to revenue. I just think good old fashioned PE ratio. He talks about it. I mean, I'm not trying to make it seem like he didn't pay attention to the typical metrics, which is PE ratios. They're high. But guess what is not high? The yields on bonds. This is what, like my man Jeremy Siegel would talk about. PE ratios and the CAPE cyclically adjusted price earnings ratios that Schiller uses are high. All these things are high without question. And one of the reasons, part and parcel for that, is because negative interest rate policy in Europe, and then you go to the United States where the 10-year Treasury. Actually, I haven't looked at a couple of days. What, 2.7 something? Let's take a look. The 10-year Treasury right now is 2.71. All right, so there's a 10-year Treasury, the TNX, 2.71. So that's up from 2.66 a few weeks ago. That's 5 basis points. I mean, it can, Alan Green, I can't remember who's Jerome Powell sneezes and the Fed, the 10-year Treasury goes up or down by 5 basis points. That's nothing. And so right now you're getting 2.71 on a 10-year Treasury. Historically, it's about 5.5. So you're getting half of what you used to be able to get on a 10-year Treasury. PE ratios, you have to look at it in the context of all your investments, the opportunity cost. Where else could you park your money? So if PE ratios are high, and they're not even that significantly high. I mean, we're at 17, 18. I mean, that's high relative to historical norms, about 15.5. This is not nosebleed section of 1999 pets.com. It's not by any stretch of the imagination. And then you factor in the 2.5, we'll just say 2.75, 2.75 on the 10-year Treasury, which is half of what it historically is. You can make an easy case that PE ratios are low relative to historical opportunity, the substitute effect. I'm investing in this. That means I'm not investing in that. I'm investing in this because that looks crappy. This looks a whole lot better than that. And that looks crappy is a 10-year Treasury, which got to pay tax and inflation. After tax and inflation, you're going to lose it. You're going to lose money. There's just no getting around that. Now, I thought was pretty interesting is his, I like a lot of this, what this guy said. I completely agree. The consumption going down. So a consumer dictated society, which we have been with the baby boomers, spend. And when that stops, inherently, that's going to change things in terms of overall economic forecast and growth and whatnot. I agree with that 100%. But the question is, as always, has the growth been curtailed by government policies that have limited capitalism? And I think the answer is absolutely yes, without question. I mean, look, this might be me, showing my political favorite here, but I think over 8 years of Bush and 8 years of Obama, not allowing the capitalistic behaviors of growth just resonate throughout society with manufacturing and everything else too. And then and then on top of that, they're trades which hurt our ability to make products and whatnot. I'm excited by that. I think there's upside for GDP to grow because we're going to make more stuff here. Absolutely. That's not a mercantilist protectiveness. No, I don't, not in the least. It's just saying at the end of the day, we're going to operate on fair trade realms, what everybody else is doing in other countries. So other countries aren't going to take advantage of us anymore, where we're having them build stuff for us that we spend our money on. We're going to do it here. And so we're probably declining of some consumer spending because of a couple things. You're going to have more domestic manufacturing that will increase prices without question. Increasing prices on top of a generational shift to less consumption because baby boomers are retiring. That will also deflate consumption spending for sure. Then on top of that, you have these millennials who are so heavy in debt from college and whatnot, they don't have as much money to spend. I completely agree with that. I 100 and unequivocally agree with that, what this guy is saying. So consumption will go down. So an economy that's based on consumption spending will be rearranged without question. I don't have any problem with that at all. Now, part two of this, if these millennials aren't buying, this is what I think I'm telling you right now, I'm 48. I've always felt like this. This is where opportunity lay. So millennials are coming up and they're not going to have enough money to afford things, all right, because they're so heavy in debt and their consumption as a whole is being lessened because they don't have enough cash, disposable income in which to consume. Baby boomers are also consuming less. And on top of that, prices are going up because of more restrictive trade and more domestic manufacturing. That's going to be a negative on consumption. That's for sure. Now, here's the interesting thing. And this guy actually, to his credit, addressed it. He said, we don't know how to take into account the fact that there will still be a significant transfer of wealth from baby boomers down down to their heirs. And I don't know how you quantify that. I've seen papers, lots of my business say, oh, you got to go after the largest transfer of wealth is going to take place. There's $3 trillion at stake and all that. And I get that. And so they really want you as a financial advisor to go after these people because they're going to get a lot of money inherited. Essentially, don't overlook millennials. Now, that is probably going to be true, especially given what he said is that the declining consumption of these people who actually have money set aside will mean they have more money to transfer downstream. I don't know how you quantify that in terms of consumption spending. I would think if anything, it would mean more debt spending to pay off debt for sure, loans. But anyway, so here's the opportunity. I'm telling you right now, I've thought this for a long time. Baby boomers were the most spendthrift generation in the history of the world, without question. They just spent. They love to show how wealthy they are by having their nice cars, by having their second homes. All right. So baby boomers now, they have second homes in the mountain Gatlinburg and down here in Orange Beach, over in Destin, Florida. You name it, Park City, Utah, right? Because these baby boomers who went to law school and spent all kinds of big bucks, that's what they felt they need. I mean, some of them are very narcissistic. There's no getting around that. And if you're a baby boomer and that offends you, I'm sorry, but that's just the way my generation views you. It's very narcissistic. In fact, there's an old song by a hardcore band out of Boston called Tree, called Negative Hippie, and they said basically, it's just funny. It talks about how the hippies of the 60s became the yuppies of the 80s, the greediest hypocrites of all time. Baby boomers are a lie. Or was it greediest hypocrites of all time? I can't remember what it was, but it's a funny song that talks about how they smoked up all the product, spreading the disease, and then handing me the bill. It's actually a pretty good song. Now, if you don't like hardcore punk rock metalish music, you won't like it, but it's a good song because that's how we look at the baby boomer generation. They enjoyed all the fun and they handed us the bill, and we're passing on down to our kids, the millennials. But anyway, so all these baby boomers have these second properties, maybe even third properties, for heaven's sake. They're not buying any more third, second properties. There's going to be less and less demand for those properties because the millennials coming up can't afford their homes to begin with, never mind a second property. What do you think happens to the prices when the supply increases, because all these baby boomers can't afford to maintain them anymore. They just they never go to their beach houses in Orange Beach. What do you think happens to the prices? So supply is increasing, more and more supply, right? Less and less demand because the millennials can't afford them. They're not buying them out there. In fact, when they inherited them, what are they doing? They're not demanding. They're increasing the supply because they're selling them to pay off their debt. What happens to the price? When supply increases and demand decreases, the price drops like a brick in water. I'm telling you right now. I'm telling you, if you want to buy a vacation home, hang tight, because I'd say probably 5 to 10 years, you'll be able to buy one on the fly. I'm also telling you, too, something else that's interesting about this, and a kind of corollary to what this guy was saying. You have less bigger families coming up, all right? You have less millennials who can afford homes. So you have smaller families and less consumable resources in which to buy homes like what I'm in right now. Well, you doggone better be getting out of that home, that big 5-bedroom, 4-bath home before too long, because you're not going to find many buyers for it at some point. It's not, because the millennials coming up, a lot of them don't have the resources to pay for it unless they receive a large inheritance. But I guarantee a lot of that large inheritance is going to go where? It's going to go paying that student loan debt that they have for sure. And then the credit cards and the car loans is going to go out to paying off that debt. So you have all these people with these big homes and not big families, and you were able to buy the home in a debt-ridden society that will slowly dissipate because there's going to be less and less consumption and less consumable resources for millennials coming up to be able to buy the home that your old buddy Josh finds himself in now. Highly suggest you think about downsizing before it's too long, because what happens then, again, supply increases, demand decreases. What happens to your price of the home you want to sell that you thought you'd get for $500,000? It's going to go down. Add to that potential for increasing in interest rates. And I don't know that's going to be true, but just potential for increasing interest rates, increasing supply, decreasing demand. That's strike 3. Your value of your home that you're relying on to fund your retirement will quickly be reduced by a significant amount of money, without question. That's even if you can sell it, which is another reason why I don't poo-poo the idea of reverse mortgage, because you can't sell that home and you need to get equity out of it. What are you going to do? Well, you're not going to be able to take a home equity line of credit because, again, banks don't give home equity lines of credit to people who don't have income. So it's a reverse mortgage will be your saving grace. So don't just say, oh, reverse mortgages are scams. It might be the only thing you have. All right. Another thing this guy talked, which I for the love of me, I don't understand. The European model of bonds, a risk-off asset, and we are in the U.S. a risky asset. I don't agree with that at all. I mean, bonds are not a risk-off asset. They're not, because again, never mind the negative interest rate policy of the European Union. The facts are a 3% bond, 2.5% inflation plus taxes. You're not making any money. I mean, literally not making any money. At least with stocks. As long as they're making money, you can expect to get at least a positive return over 5 to 10 years, without question. Will that return be lower than historical norms? Yes. I think most righteous people would say you're probably looking at 4 to 5% real return after inflation. But 4 to 5% real return after inflation is a hell of a lot better than 0 to -1 after inflation. And again, we're talking after inflation. And if you factor in taxes as well, you're looking at probably a 3 to 4% return on stocks versus a -1 to 0% return on bonds. Now, stocks will have the ups and downs, as we've seen since the dawn of mankind with stocks. Yes, they will. We've just been through one. And so the idea we're going to have a major sell-off because of recessions and don't do anything in terms of creating a huge sell-off. Sell-off happens all the time. We don't know why. There's no rhyme or reason for it. So don't get all sweating about the recession. Man, we've had it's like saying the bear market. We have bear markets every 4 years, man. It's not, unfortunately, there's no, it's completely random. It's not where you go 1, 2, 3, 4 bear, 1, 2, 3, 4 bear. There's no standard to it. It's completely random. But we have bear markets all the time. So this idea of bear market's coming, recession's coming. Man, this stuff happens all the time. I mean, it literally has nothing to do with the baby boomers and the millennials. It's just the nature of the economy with human beings. It happens all the time. And so if the alternative is to go to bonds, I don't get that in the least, because you're guaranteeing a loss. It doesn't make sense at all to me. So I don't buy it. And he didn't really say that so much. He was talking more about crypto, rental trailer parks and whatnot. I thought that was actually pretty insightful for sure. But he was against stocks, thinking, a crash is coming or it could be a recession. I just look, man, that's just par for the course. So my thought process, all right. So as always, you got to mitigate your risk. And the risk is, what if you're right and what if you're wrong? So what if you're all in stocks and you're right, then you're loving life? What if you're all in stocks and you're wrong, then you're hating life? So what do? Well, in my opinion, I think you buy CDs. You don't eschew bonds outright. Forget bonds. Just buy CDs. You say, look, if Josh is right and I have 70% of my assets in stocks, I'm loving life. If Josh is wrong and I have 70% of my assets in stocks, I'm hating life. So what do I do with that 30%? Do I increase it? Maybe do 50-50, 50% stocks and 50% CDs, 1, 2, 3, 5-year CDs, ladder CDs. I'm telling you right now, cash is an asset class. Cash is an asset class. There's no volatility in cash, none whatsoever. If we do go to a deflationary economy, and I'm telling you, I'm somewhat convinced that's happening. And deflationary, I don't want to get too into that. It still takes into account inflation, because the Fed has an inflation target of 2. I think it's 2 or 2.5, whatever. But they have an inflation target, right? So we go into a deflationary economy where the price of goods declines because there's less consumption going on. Well, guess what happens then? Cash looks better because cash does not decline. Cash stays flat. Now, the drawback about a deflationary economy is your stocks might not look so good, because they're going to be less and less and less earnings per share and whatnot. So the PE ratios could go down, which means the price could fall without question, but they could fall in an inflate. That's the thing, is they could fall all the time. So if you're worried in that regard, then split it. Do a hedge. Say 50-50, 50% stocks in case Josh is right, 50% cash and CDs in case Josh is wrong. It's a win-win. All right. Yes, you are some opportunity costs, and that the stocks could get hammered, or that the cash might not do well, the stocks do well. That's the hedge. Hedging is about risk, mitigating risk. It's not about all in, because if you're all in, man, you can make a hell of a lot of money, but you could get slaughtered too. So in this case, you're saying 50-50, 50% stocks, 50% cash and CDs. I'm telling you, man, and that's why I always say cash is an asset class, without question. Because when markets go down, and markets across the board, bonds are a market, cash looks good, and you'll be glad to have cash on top of that. Now you want that vacation home 5 to 10 years from now. That's because the market's being flooded, and you got cash on the side, not in bonds, but in cash. You pay cash money for some guy who's desperate to sell, and he bought it for $400,000 in Destin. Now he's like, he can't get a bid for $3 million, and you come up there and say, here's $250 cash. That gotta be help. He'd take that, and you're loving life, and then you don't have to touch your stocks. It's a good place to be. So anyway, I like this video. I think you should watch it without question. I thought it was pretty insightful. I do. I don't get the whole thing on the creating the scariness about stocks. Recession of stocks, I just don't get it. Stocks always carry risk. Recessions are here all the time. I do think that it's pretty informative about the consumption cycle that we're going into, for sure. I completely agree with that, without question. I thought it was pretty insightful about maybe renting some trailers, for sure. And like I told you before, I had a guy, literally you couldn't get much more white trash guy than this, but out in the Shenandoah Valley, and he had 6 or 7 units in one trailer park, and he was buying more too. So